How do I get rich? How can I make a lot of money? Is there an easy way to get money? If you have similar questions, then I can tell you that you're not the only one. Getting rich quick involves a high percentage of luck and risk. In today's video, I will show you the easiest and safest way to make money. To be exact, over $1 million. Greetings everyone and welcome back to Stock Miner. I would like to take a moment and present you this very simple chart. On the y-axis, you see the probability of monetary success. On the x-axis, you see the duration of your investment period. If you take a shorter duration, the probability of success is obviously very low. And if you take more time, the probability of monetary success will increase. But why is that? Room for error. Our economy, especially stocks, cryptos, and currency pairs, are almost unpredictable and fluctuate a lot. Roughly, there are 3 investment periods when we talk about stocks, crypto, or forex. Number 1, day trading. Time horizon, maximum 1 day. Important economic events allow us to predict the trend of assets in the short term. In theory, this can be predicted, and it often occurs, but with a very high fluctuation and sometimes with outliers in the other direction. Candlestick patterns are also very popular, where a prediction is made based on the formation of the chart. Classification. On the scale just shown, trading is the absolute riskiest, mainly because of the time factor. On the other hand, a single trade with a movement of a few digit percent can bring in hundreds of dollars in just a few minutes. Room for error. Here it is just a few minutes. If a trade gets an opposite momentum, there is not much you can do. Especially with leverage trades, the loss is quickly above 10% of your account balance. Number 2, stock trading. Time horizon a few days up to 3 years. Stock trading is a more subdued version of day trading. The reason for that is that stock prices, generally speaking, fluctuate less than the currency pairs in trading, for example. This makes it easier to follow the trends, and the roller coaster of emotions is not too exhausting. But even there, unpredictable incidents can occur. In my case, I invested in hydrogen stocks when the sector returned to buy level after a trend. But the outbreak of the pandemic, followed by the war, caused a lot of bearish momentum, and the stock has been stuck at minus 50% for almost 2 years now. Classification. Definitely safer is this strategy. The risk is nevertheless increased since the time span is not always sufficient to survive an unforeseen economic event. Room for error? With my hydrogen example just shown, it is worth waiting and letting the sector recover over several months. As the fluctuations become less significant, they are balanced out over a longer period of time. And so to number 3, the classical investing. Time horizon is more than 10 years. The oldest of these 3 types is the classical investing. It has by far the highest success rate. In a period of more than 10 years, price fluctuations and economic setbacks such as a pandemic or a war disappear completely. In this way, you invest in the economy and its growth. Classification. Only here the risk becomes vanishingly small when a longer holding period is taken into account. However, the extended time span might be a disturbing factor for some people. Room for error, large. Let's look at the impact of the corona pandemic on the S&P 500 chart. On the scale of stock trading, it was incredibly difficult to make a profit during that time. If we zoom out to the scale of classical investing, we see that the economy has already recovered from that. For an investor, this was merely a hiccup. So coming back to the question, if there is an easy way to get rich, the third investment strategy would be the answer to that. In fact, there is no easier way to get rich, guaranteed. But for many people, there is one disturbing factor: time. If you want to get rich at a young age, you want it to happen fast. And as we said in the beginning, getting rich fast involves a high risk and an even bigger portion of luck. Investing money over 10, 20, or even 30 years takes discipline and a lot of patience. Have a lifetime of patience for the rest of your life in wealth. But let's cut to the chase and let me show you an example, my example. Step 1, find your investment. I have chosen an ETF with many stocks, broadly diversified, and a good return of investment over the last 10 years. It doesn't matter if you take the S&P 500 or an all-world index or a fund offered by your bank. The important thing is that it is broadly diversified and represents companies from all over the world and from all sectors. This is the best way to represent the global economy. Step 2. Your investment plan. Here, just start as early as possible with however much goes, even if it's $100. We will look at the results shortly. Set up a standing order, a sum that you invest continuously. You can do weekly, monthly, semi-annually, whenever you want. I recommend that you invest as often as possible. But why? Cost averaging. You compensate for price fluctuations. If you invest 2 times a year and get a high price once, it will be more significant than if you invest every month, but buy 3 times at a high price. But also consider the investment fees. If they are very high, as with a bank, then invest rather larger sums in further intervals. On broker apps, the costs are usually lower, so there you can deposit weekly. I have an interval of every 2 months. And now for the exciting part, step 3, the effect of compound interests. I will leave you a link to a calculator in the description so you can see your own example and play with your numbers a bit. My initial deposit was $11,000. Every 2 months I invest $2,000, which will be $1,000 per month. My fund has a return of investment of 6.7% per year. That gives me a value of about $192,000 for an investment horizon of 10 years. The investment would then be $131,000, so $61,000 of profit. If we now estimate 20 years, one could think that the profit is just doubled, so $122,000. But because of the compound interest effect, it is $293,000. My total amount would then be $544,000. And here it comes, 30 years investment horizon. I'm 22 years old now, so at 52 the investment would be over and it will be worth $1.2 million. Of that I invested $370,000, so the profit is $860,000. $860,000 for saving a little, putting it aside and creating a standing order. Who became a millionaire in an easier way? The earlier you start, the stronger your compound interest effect will be. So look at this. Instead of investing $11,000, you invest $100. Same fund, same conditions. You get $1.15 million in. So you could invest $100, but you decide to save $10,000 and only then invest. You start 2 years later, but like me, you want to retire in 2052. The value is now only at $1.05 million. Despite your higher initial deposit, you lose around $100,000 in just 2 years. So the conclusion, start now with whatever you got. As the saying goes, the best time to plant a tree was 20 years ago. Second best time is today. I hope you enjoyed this video. Thank you so much for watching and I'll see you next time. Bye bye.